I'm John Cunnison. I'm the Chief Investment Officer at Baker Boyer. We recently hosted an economic update, a virtual presentation on the economy, on markets, and on the election. And with this election coming up, we wanted to take that segment of that presentation on the elections and its likely impact on markets and provide it to you again in a shorter format. So please enjoy this section of the presentation. If you have any questions, please reach out to any member of your Baker Boyer team. As always, stay well, and we look forward to hearing from you soon. So in talking about the election season in particular has been, I think, more emotional for all sides than I've ever witnessed in my career or my lifetime. And if you're feeling particularly stressed about this election, just know that you're not remotely alone. And it won't surprise any of you that I've heard from clients probably more often than I ever have, basically asking the question, should I alter my investment portfolio? Should I reduce the level of stocks? Should I go to cash? And there are a few times that I will give, a firm declarative answer to a question with investing. It's usually all talking about probabilities of outcome, situation. In this case, there is an answer, and the answer is no. And I make a plea to all of you, please do not express your political views through your investment portfolio. I think it's universally a bad idea. And why don't we take just a brief look at history to look at why that's the case. So it's natural for investors to look for a connection between who wins the White House and which way stocks will go. That's incredibly natural. But as you can see, stocks have trended up over nearly a century, regardless of who was in the White House, regardless of the makeup of Congress. So you have to remember that shareholders are invested in companies, not political parties. And these companies are, focused on serving their customers, building value, and growing their businesses. So it's important to remember too that, when Barack Obama was coming into office, there were expectations that his presidency would be really bad for the stock market, and yet we saw 8 years of tremendous gains. The same was true of President Trump when he entered office in 2016. In fact, when he declared victory, late on the night of, it must have been, I forget what day it was, but in overnight trading, the market began to sell off heavily. I think at one point it was down 7%. Of course, when the market opened in the morning, it rallied. So the fact of the matter is, it's just too simplistic a take, right? There are hundreds, if not thousands, of things that affect the trajectory of stocks. Those things include the actions of foreign leaders. They include rate changes, rising and falling oil prices, technological advances, pandemics. So all of these things can affect stock prices outside of who happens to occupy the White House or what the makeup of Congress is. So you may be saying, well, that's fine overall for a long period of time, but what about specifically in election years? And this is data from Vanguard. Each of those bars shows a year going back more than a century, and the gray bars are non-election years, the purple bars are election years. And if we just look at it briefly, we can see that there doesn't seem to be any discernible pattern, and that turns out to be the case. If we look at the average return for those election years in purple, we see that the return on average is 8.9% for those 40 periods. If we look at non-election year returns, it's 8.1%. This again for US stocks, 120 periods. The message we should take from this is not that we get 9 or 0.8% more during election years. It's that there really isn't a meaningful difference between the two. So obviously there's something else going on, and that's looking at returns. What if we were to look at volatility, or which tends to be a proxy for risk? And what we can say is, in the 100 days before presidential elections, volatility averages 13.8%. In the 100 days after, again, 13.8%. And if we look at volatility in all periods, it averages an annual 15.7%. So I think what we can take from this is volatility isn't any higher or lower, even leading up to or in the aftermath of presidential elections. So neither risk nor return is different when election season comes around. So I can hear all of you almost thinking through your computer at me, John, I get it. Those are interesting historical anecdotes, but this election's different. And on this score, the dominant narrative that I have been hearing is, President Biden will increase regulation. He will increase taxes on corporations, which will lower profits, and it will cause a correction in the stock market. That narrative seems reasonable. But again, there are hundreds of thousands of things, or not hundreds of thousands, there are thousands of, maybe there are hundreds of thousands of things that affect the future direction of stock prices. Now, if we just look, for example, at polls, what we see is that right now polls do favor Biden. So by about 85%, and this is according to 538.com. If I've looked recently at, and this is looking at polls, if we look at betting markets say something similar, 60 to 70% chance of a Biden win. And even the chance that the Senate will go to the Democrats. Even those odds are looking favorable or in favor of the Democrats. Now, I'm not suggesting here that a win for Biden is good for the markets, but we are seeing that as polls begin to favor Biden, markets are hitting record highs. I think, and what I'm really suggesting here is that there are many more things that go into stock prices than who occupies the White House. I do think that one of the things that markets tend to rally on is a reduction in uncertainty, right? We live in uncertainty times all the time, but there are times when it is particularly high. An election period is just such a time when the outcome of the election is binary. It's going to go one direction or another. And in that period of time, there is heightened level of uncertainty about the future. To the extent that polls go one direction in a more concentrated way, that reduces uncertainty. And some people would suggest that that is positive for markets. And again, the takeaway here is the markets don't necessarily care who wins the White House. What the markets want is some certainty and the ability to plan for their businesses. The other thing that we've seen markets move on is fiscal stimulus. And I'll talk in just a moment about why fiscal stimulus is so important when we go through the economy. But right now, fiscal stimulus is expected by the markets, and it will be very, very important for continue the recovery of the economy. And the markets tend to rally on days when fiscal stimulus seems more likely, earlier, and greater. And the market has tended to get softer during periods where that fiscal stimulus is called into question, might be pushed out, or it might be lower than we might otherwise have thought.